Today we're going to show you why the pace of rate cuts matters. Two sectors you're going to want to buy into weakness. Hey, I'm going over the latest macro insights from Alec Young. It is a beauty. So let's go ahead and talk about some data. The first thing you guys need to know is that recession fears, in our opinion, are overblown. Again, you know how the recessionistas, they have been really out and about over the past couple of years. And the latest issue that people are focused on is that they're worried about rate cuts. They're saying that the Fed is behind the ball. Well, here's the deal. GDP forecast for Q3 stands at 2.1%. You've got upper income consumers still spending money. Here's what you need to know. Don't be worrying about how many cuts, that many cuts, big cuts, little cuts. Focus on the pace of rate cuts. That is what matters. Slower is bullish for stocks. Check out this chart. This is one you're going to want to definitely cut out, post it, put it in your bedroom, make sure everyone sees it. This is the S&P 500 performance after the first Fed rate cut. In the darker color, we've got slow rate cuts, and in the lighter color, we've got fast rate cuts, okay? This is going back to 1954. So slow rate cuts, right? Quarter basis points here, quarter basis points there, tends to be very bullish for the market. Usually the economy is humming along. When you're doing fast rate cuts, we could be in trouble, right? You start to think about 2008, 2009, maybe even 2020, right? Because we had some potential worries there with the government shutting things down. This is the bottom line. Slow rate cuts, average percentage gain for the S&P during the first year is 24.4%. Fast rate cuts is 5.2%. So it's a huge difference. Second year, 6.1% gains for those slow rate cuts and 10.9% for those fast rate cuts. Slower is better as it relates to stocks. So now that we know and we believe that it's going to be a slow rate cut cycle that we are entering into, here are two sectors to buy into any pre-election dips. Before we get into that, I want to share a chart that I shared with you a while back. This is looking at the S&P 500 average presidential election year returns from 1928. So almost 100 years of data. Bingo! September and October tends to be the weakest months of an election year. So we're not surprised to see September having trouble for stocks. Don't expect that to go away because October also tends to be weak. And with election uncertainty, it just makes sense. Once that election is known, once we have a victor, markets tend to put ballast back into stocks. You start to see November with a 1.2% average gain and December with a 1.5% average gain. So obviously you're going to be wanting to be buying high quality stocks on the dip. So which areas do you want to be focused on? Well, what areas are getting sold right now? Well, we know that tech stocks are, right? But also you want to be focused on financials. And here is why. If we go back in history and we look at which sectors do the best during election years and the following year of an election year, you can see financials have an election cycle average of 17.7%. Technology not far behind with 15.4%. Those are market beating gains. Those are the top two areas that continue to show ballast in our data. Those are the ones that we believe institutions just keep buying week after week, month after month. If we also look just in recent data, the best in show year-to-date S&P 500 sector returns, you've got technology at just about 21% year-to-date gains, financials at 20.4% year-to-date gains. So this theme is working out if you look at it through the lens of history. Also, utilities are actually doing well year-to-date, as are comm services. Let's keep going. Let's look at the map signals sector ranks, and financials continue to be the top ranking group. Utilities not far behind in real estate. Just filmed a great video on dividend growth. These areas are going to thrive as rates come down. And then you see technology doing just fine. It is still a top 5 sector. It is potentially on sale, and we believe it is. A lot of stocks here to be looking at. Here's the bottom line is you want slower rate cuts, not big rate cuts. That would indicate that there was trouble brewing in the economy. We don't see that. We see growth just humming along. Two areas of focus you want to be looking at to potentially buy the dip: tech and financials. Those tend to do very well in election years. And you know what? Those are the top performing areas of the market year to date. So listen, sometimes history rhymes. This year, it definitely does. If you want awesome stocks to consider looking at Map Signal's Pro subscription, where we look for the top ranking stocks with amazing fundamentals that we believe there is institutional buying along the way. That's how you beat the market. I'll talk to you guys soon.